All right, now we're live. Tonight's session is Option Basics Part 2. We're going to pick up where we left off in Part 1. Before I really go into anything, what I'd like to do is just talk just a little bit about some things that we have to get out of the way, some housekeeping chores. Trading securities can involve high risk and the loss of any potential funds invested. Any investment information provided by our user group may not be appropriate for all investors. It's provided without respect to individual investor financial sophistication, situation, time horizon, or risk tolerance. Therefore, any of the information and techniques we provide by our user group or any securities that we talk about are for educational purposes only and are not intended to be a recommendation to buy or sell any specific security, no matter what your rat brain may want you to do. So, having gotten some of these little particulars out of the way, why don't we just jump into everything? Tonight, Options, Part 2, the agenda. What we're going to do is, we're in basic options here, guys. So I still see a couple of folks on there that are intermediate and a few that are advanced. So it's good that you're jumping in, because I can tell you, it's just like a pro golfer. You always need a little bit of someone watching to make sure you're not slicing or chopping the ball the way you should. So anyway, tonight we're going to do a quick review of puts and calls from Part 1. We're going to then start into some new things around options pricing and the Greeks. It's all about the math, folks. When you start getting into options, unlike just going long stock, most common traders just, buy 100 shares of this, 50 shares of that, and they're good to go. But options is completely different. Generally, most people don't go from trading futures to trading options. They go from trading stock to trading options. And most people that get into the markets for the very first time don't jump right into options. They generally go through the stock process first before they get comfortable with options. So we'll talk about how options pricing is different than stocks and what the Greeks are about. So even though this is basics, we're going to get into some of these things in Greeks about the math. And I know when you graduated high school, you thought you could kiss some of that stuff goodbye. Well, I promise the math and options is not that bad. And we'll focus on the stuff that's really important, the stuff that can get you into trouble if you don't watch what you're doing. So options pricing in the Greeks. Then we'll just put on a couple of trades so that you can see. We had talked about the P&L diagrams last time, so we'll go back through them. We'll put on some sample trades with calls and puts, and then we'll just kind of summarize everything. So most of the night, we're probably the first 20 minutes or so, we're going to review what we did last evening, but then we're going to spend a lot of time on the Greeks, because I think that is the most important thing if you're going to even touch options. All right, if you don't learn the Greeks, then don't trade options. That's the best way to say it, I guess. So why don't we jump into everything here? So before we talk about this, let me just back up 1 second. I want you guys to think about options, especially the newbies out there. Think about options like a football game, and every team that comes in and plays against another team has odds on whether they're going to win that game and by how many points they're going to win or lose that game. Now, imagine being able to place a bet on your favorite team. Let's call them the Red Bulls. And let's say you're going to bet on the Red Bulls to play a game. Well, it's not just I'm going to bet that they're going to win, but imagine you have an active bet with the Red Bulls, and then at the end of the first quarter, you can change that bet if you want. So let's say at the end of the first quarter, and the Red Bulls are up by 7 points. Do you want to sell that bet that you made in that wager and take some small profits and get off the table, or do you want to hold that bet because the Red Bulls are looking pretty good and the team that they're playing isn't doing too good? So you think by the second quarter you're going to make more money. So you say, well, I'm going to stay in the bet. So by the end of the second quarter, the team that you were playing is now tied the game. So you're like, uh-oh, well, I should have taken my money when I had my chance in the first quarter. But then you can hold on through halftime into the third quarter and then to the fourth quarter. The nice thing about options is it is not like stock. With stock, you've got a stock certificate and you've got an underlying asset. With options, they're really a trading instrument against an asset or an underlying asset. You'll hear the term underlying. So that means every option has no value. It derives, hence it's called the derivative. It derives its value from an underlying. And that underlying can be stock, like an equity, IBM, or it can be an ETF. You know, it can be one of those. It could be a futures contract. It can be an index. It can be a number of different things. So options derive their value from the underlying that it writes. So when you write an option contract, or you create an option contract, or you buy an option contract, you're buying a contract to perform some kind of task over a limited period of time. Now that time can be one day, it can be a week, it can be a month, it can be a year, it can be up to 2 or 3 years. In fact, the CBOE on December 26th of this month is going to be announcing their LEAP contracts through 2015 for certain indexes and assets on the 26th. So you can buy, as we talked about in part 1, something called LEAPs, which go out more than 1 year. So, you know, options have this decaying component to it. So why don't we just jump in and just talk about the types of options. Now, in part 1, we had talked about there's really only 2 types, calls and puts. And with a call, as you can see right here with a call, when I say that I am long a call, now, one thing that I think a lot of beginners get confused with, a lot of people just think, well, if you're long, you're bullish, right? Some people go, every time I'm bullish, I'm long the markets, or I'm short the markets, mean I'm bearish. So they hear those terms and they just think, well, if you're long, you're bullish. Well, when you get into the world of options, long does not necessarily mean you are bullish, all right? All long means in the option world is that you bought an option contract. All right, that's all it means. And if we look at a long call, you have a right to buy an underlying based on that option contract. So long comes with rights. The expectation in this particular case is bullish. It's a debit trade. I like to call it, you got to pay to play. And it's a buy to open. So basically what I'm saying here is you're buying, all right, so that's why I'm saying you got to pay to open the trade, and it is an opening transaction. So you're opening a transaction by buying an option contract. You are an option holder, okay, so you hold that contract. If you could keep everything in your house instead of the brokerage firm holding it for you in electronic form, you would actually have that contract sitting on your desk saying, this is my contract, I'm holding it. Now, let's look at the other one with a put. If we say we are long a put, well, obviously in this particular case, we are long, right? We are long, but in this case, we're not bullish, okay? We are basically saying we are bearish because a put is a bearish position, but we're long. So just keep in mind that even though you say you're long, that does not mean you're bullish or bearish. You are just buying an option contract here. So again, because I am long, whether it's a call or a put, I've got rights. In this case, I don't have a right to buy, I've got a right to sell. So with puts, it's just the opposite of calls when you're buying to open a contract. With puts, my expectation is I'm bearish, I'm buying it, and it's an opening salvo. It's my opening transaction, and again, I am an option holder, just like the calls. So I am buying that contract. So, and my expectation, of course, is bearish, so it's just the opposite. But again, it's a debit trade, meaning I got to pay to play, all right? Very simple concept to understand. I think what confuses a lot of beginning traders when you get into the options is much like when you go, I'm sure there's some gamblers out there, some poker freaks, as well as craps and a few others. And generally when you get into craps, there's a number of bets and a number of side bets. Most people, most craps players will play on your side. Very rarely will you play on the house side and take the counter bet. Well, in options, it's very easy to switch sides and go the other way. And the first one, let's take a look at, is a short call. So obviously, just by looking at it, you already know, well, if I'm long a call here and I'm short a call here, then the short side must be exactly opposite of the long call. Well, you're right. My expectation is I'm bearish. But the key with a short in the option market as an opening transaction, all right, I'm opening this transaction, I'm opening it right here, is I've got an obligation. I don't have a right, I've got an obligation. The difference between a right and an obligation is with an obligation, I have no choice, all right? And who do I have no choice to? The buyer. The buyer is the holder of that contract. They're going to enforce their contract terms on me if it meets the particular parameters that force me to do this. So I'm obligated. It's a credit trade. So I get paid to play. There are a lot of people out there that do nothing but put on credit trades, meaning they get paid to put the transaction on, and basically they put the risk over here with the long call buyer. The risk of the trade is over here. This is where the risk stands. For that risk, the long call buyer typically has a higher rate of return or return on investment. Their return on investment is relatively high. On the short call side, because they don't bear the risk, generally their potential loss can be higher and their return on investment is lower. And we'll show that in some P&L graphs. So this is the world that the short call or the credit trade player lives. But the probability of success is generally 70% or greater for the credit spread trader. Over here on the long call buyer side, their probability of success is around 40%, maybe a little bit less than that depending on their strike placement. So because they have a lower probability of success in a trade, they're going to demand a higher rate of return or return on their investment for that risk. And because the writer of that option contract, being the call guy here, the guy that's going to short the call or the woman that's going to short the call, they go, all right, well, I got a 70% chance of success. I'm going to let this guy over here bear all the risks. So I'm willing to take a less of a return. The option markets, as we talked about in part one, the option markets, as we talked about in part one, is very conducive to the mathematics of how these things work. So it's all based on mathematics, and we'll get into this into the Greeks. But this is the short call side. Now let's look at the other one. Let's look at the short put. Well, naturally, the short put is just the opposite of the long put, just like the short call is the opposite of the long call right here. So if we look at it, though, a couple of similarities appear. With a short put, just like a short call, you've got obligations, okay? But now remember, over here with a short call, you've got an obligation to sell the stock. With a short put, you've got an obligation to buy the stock. Remember, that is just the opposite of a long put where you have a right to sell it versus an obligation. So I think for the beginning option trader, this is where you can get fairly confused if the markets are moving quick and you've got to think really quick. Eventually, this comes to you pretty quick. It's kind of like if you've ever learned how to drive a stick shift car where you're shifting gears. When you first start, your brain just doesn't coordinate with your right foot, your left foot, and your hand trying to shift the gears. So you've got to think through every move. But after a while, you can stop on a hill, you can stop anywhere, you can carry on a conversation, and unfortunately, you can talk on the phone and text while you're shifting gears with everything and drink your hot coffee in your lap while you're doing everything because you're not thinking about it. Well, once you start trading options and you get really comfortable with this, the same thing holds true here. But with a short put, you've got obligations. Just like a short call, you've got obligations. The expectation is bullish with a short put. Again, you get paid to play. It's a sell to open position, and you're an option writer, just like here. So just a couple of things I want to point out here that I think are key. With a short put, your expectation is bullish. With a long call, your expectation is bullish. So now you've got a similarity between these two right here. So as an option trader compared to, let's say I'm just trading stocks, if I'm trading stocks and I'm bullish on IBM and I'm a stock guy, what do? I buy the stock. It's very simple. It's just about as easy as you can get, all right? If I'm bullish Google or I'm bullish other stocks, I just buy them. That's all it is. With options, it's not so simple. If I say I'm bullish a stock and I want to trade options on it, well, as you can see here, I can go long a call or I can go short a put if I'm going to do a single leg trade, and I can play it either way. So I can use a call to play a bullish position. I can use a put to play a bullish position. If I use a put and it's just a short put, I know that my probability of success goes up, but then my return goes down. If I play a long call, I know my probability of success goes down, but my rate of return goes up, just the opposite. So now I've got some decisions I have to make on how I play my bias on an underlying security, in that case IBM. By the same token, you can also see here that you've got the similar quest right here with a long put and a short call. They're both bearish. So now I can sit here and say, well, if I'm bearish a stock, how do I make this trade setup? Which one do I use? Do I use a long put or do I use a short call? Now this is just scratching the surface, but this begins to show you with a single leg position some of the decisions you have to go through. Now keep in mind that as we go through the Greeks tonight, it's going to basically help steer you in a direction that says, I'm going to stay with long calls, or I may come over here with our long puts or go with short calls. Or better yet, I may add a short call and I may add a long call to it. So now I've got a multiple leg and I've got some of this going on and some of this going on, and when I add them together, I get some of this going on if I'm a beginning trader. It takes you a little bit of time to understand how this stuff works, but once you get the hang of it, the nice thing about options is it allows you to play a number of different positions that I think I had talked about before. You know, you can play a bullish position, you can play a bearish position, you can play a neutral position, or you can play a position that is getting ready to break out big time to the upside or big time to the downside. You don't care which way it goes. It's called direction indifferent. I could care less. I just want it to be a big move. Or here, I want it to stay here in this direction, or I'm going to play bullish or I'm going to play bearish. Or you can use a short put as a very creative way in your IRA to say, you know what, I want to buy this stock, but I want to buy it more at let's say $35 a share instead of an existing price of $38. So I may want to short puts with a strike price below 38, maybe down around 36, and be forced to buy that stock, be obligated to buy the stock if it comes down and touches that price. If it doesn't come down and touch that price, but it stays kind of like that or goes back up higher, then I collect the premium and I'll just try next month, further reducing my break-even cost and my per share cost by using short puts. So, I don't expect you to understand a lot of what I'm talking about if you're a basic options trader, but or a basic trader and you're getting into options, but there are so many different things that you need to look at. Now, one other thing that I stressed here, with long calls, short calls, long puts, and short puts is this right here. And this will save you a lot of aggravation. You need to come up with a strategy for a bullish play, all right? Because if you look at a stock, you're either going to be bullish, neutral, or bearish if you're getting into the option world, essentially, from a basic perspective. So if you get into a bullish perspective, pick out probably two strategies that are bullish strategies that you can use with options, and then really learn them very well. If you are bearish a stock, all right, in other words, your bias is, I think this thing over the next 60 days is going to go down, and it's going to be lower than where it is now. Then pick out two strategies that you can deploy that are bearish strategies for stock. And then if you're new to options and you're new to looking at charts and trying to determine a bias, then you're going to realize there are other strategies here as well. There is a neutral strategy, right, where you want to just say, well, the stock seems to be in a range here, so pick out two strategies that play the neutral side of the house. And then finally, just direction indifferent. I could care less. All right, so if you've got this kind of situation right here, then pick out two strategies right here. So you've got 8 strategies. When you first start, you can start right here. In fact, what you may want to do to keep it simple is just say, I'm only going to start with bullish and just learn 2 strategies and understand them very well. And I'm only going to play the bullish side. And then once I get comfortable here, I'm going to move into the bearish side. Once I get comfortable in the bullish and the bearish, and you're going to be learning all the time, then you get into some more complex strategies that use direction neutral and direction indifferent. And when you get in direction neutral and direction indifferent, then there's all sorts of permutations of these where you're trading not the price but maybe volatility, or you're playing earnings, or you're playing a volatility skew in the option chain. So for now, as a basic beginner, don't even worry about it. Just pick out, bullish and bearish and a couple of strategies. And we'll talk about a couple of really good bullish and a couple of really good bearish strategies for you to take away from here. So now, this just summarizes a little bit about what we talked about in part 1. Now let's get into option pricing. And we're going to wrap this up, and then we're going to move into the option Greeks. And I wanted to do this before we get into the Greeks just to remind everybody, because I see there's some additional folks on tonight that couldn't make last night's session. If we look at option pricing here, it really is very, very, a lot of people get confused with it, but it's not too difficult to understand. What you do need to know, though, is options pricing started out based on a mathematical formula. Now, there's other models that work, and without getting into technical details, we talked about American style options, we talked about European style options in part 1. I'm not going to spend time on that tonight, but certain models are based on American style, other models are based on European style, and others kind of have their own little nuance to them, but basically they all come within nickels of each other as far as what the option value is. So don't get stuck in the weeds. I can't tell you how many times I've coached people that are really smart. Some of them are quants, and they get in here and they get so wrapped up around the math and proving a penny here, a penny there, they're missing the market move and they're losing money. Don't do that. You do not have to make this complicated. So if we look at pricing in an option's made up of 2 components, intrinsic and extrinsic value. It's very, very simple. Those are the 2 components of an option price. Now, if we look at this and we say, okay, well, if I know there's an intrinsic value and there's an extrinsic value, we know that every option will almost 99.9% of the time always have some extrinsic value to it. Almost always. But not necessarily intrinsic value. Extrinsic value is made up of these things right here: time decay, volatility, and interest premium. It's all kind of classified under the term time premium. Now, why is that important? Every option that you buy, even if you're buying an option that's going to expire, you buy it in the morning and it's going to expire at the end of the day, has some time premium in it. The only time the option has no time premium in it is as soon as the market closes in the textbook case. So really every option has some extrinsic value, even if it's only a penny. But not every option has intrinsic value. So if you guys will recall from last time, and I'll draw it right here. So if you've got 100, 105, and then 110, okay, as the call strike, you'll notice that as the strikes go higher for calls, then what happens to the price of calls? And let's say the 100 is at $5. That's right. The price of the calls get cheaper. So this may be $4 right here, and this may be $2.50 right here. So the price of the calls get less expensive as the strike price goes up. Now, if we say the stock, let's say stock has a share value of $105. Let's say the stock price equals $105 a share. That's their price per share right now. Well, if you buy a 105 strike call, then you're at the money, right? It's an at the money price. And the location of the highest amount of extrinsic value is at the money. You're not in the money at all. So that entire value there is all extrinsic value. And assuming time freezes, and then you hold this option contract, this 105 contract, until option expiration, all extrinsic value goes from whatever it is to zero at expiration. We know at contract expiration for any option, there is no extrinsic value left. It decays. It goes to zero. So that means that when you buy an option and you look out there and say, well, how much is extrinsic value? And assuming that stock sits right there, it doesn't do anything, that's all going to waste away over the course of the life of that option contract. The intrinsic value is if that option were to decay the minute you buy it, how much of it is in the money. So if we say instead of a 105, let's say we buy the 100 strike. If we buy the 100 strike option and the option's sitting at 105, well then you got $5 that's in the money right here. And this, let's say that was $6 instead of $5. So now out of that $6 price of that option contract, $5 of it is already in the money. And $1 is out of the money. So this $1, assuming time freezes, that $1 will expire. Every day, just a little bit is wasted away. That $5 is untouchable. That $1 just wastes away. Now, we all know that you never see a stock stay at the same price over a longer period of time. Very rarely will you see a stock do that. I don't think I've ever seen it. I've seen stocks stay within a penny or two for a month or two in a buyout offer, but then everything pretty much just stops trading around that. And the arbitrage comes in and takes advantage of it. But from an option pricing standpoint, the strike price means a lot with intrinsic and extrinsic value. So, and a lot of people right now, the trading platforms point all this out. You can control this, and I'll show you using Thinkorswim, the trading platform. So looking at this example that I've got shown down here, stock price is $50, and we say this is, I'm going to buy a contract. It's $8.50 a contract, or because everything's in numbers of 100, it's going to cost me $850 to buy one contract. And this thing expires in 3 months. It expires in 3 months. Well, I paid $850 for this. How much of this is in the money and how much is out of the money? Well, it's very easy to see. I'm buying a 45 strike call. The stock's at 50. That means I am $5 in the money, so $5 is intrinsic value. So my intrinsic value of this $850 is $500. And then obviously everything else that's left is extrinsic value, or $350. So all of this, assuming the market's freeze frame for the next 3 months, that $350 goes to zero. This $500 stays at $500. So what happens is your $850 you spent now is worth $500. So in this particular example right here, you just lost $350 on that $850 investment, or you lost 41% on that trade. The stock didn't move. If you had owned the stock, you would be zero. You wouldn't have lost anything. The stock would sit there. But because you bought an option contract, you lost 41%. That is the value or the lack thereof and just how bad time decay can hurt you over a longer period of time. Now, when you know this and you start trading options and using the Greeks, we go, well, we're not stupid. Let's take time decay and use it to our advantage. Let's play it and let's use time decay to our advantage. But there are a couple of other things that are happening in the market too. One of the things that's happening in the market is this thing that we call volatility right here. Volatility is what I call the great white shark in option trading. And the reason why I say that is because volatility outside of the underlying stock moving up or down, so this share is $50 and then over a 3-month period it could move up to $60, or perhaps it could stay somewhere steady and close at $50, and somewhere in the middle it goes up and down, but then it closes at 50, or over 3 months it can come down to 40. So there's only really just a couple of things that this $50 can do over 3 months, right? And you're betting on the direction you think it's going to go. Well, volatility is going to measure just what kind of fluctuation this stock is going to play in this cone going forward. And volatility affects the price of this option. And one of the ways that you can control volatility, even if you just buy a long stock, you're going to buy a long call, all right, is by going deeper in the money, and I'll show you why in a minute. But to give you the answer at the beginning, and then we'll jump into it, volatility only affects this right here. A lot of people don't realize this. Volatility only affects the extrinsic value of an option. Volatility cannot increase the intrinsic value. It only affects the extrinsic value of an option. Okay, and you're going to see that. Time decay is another one, and guess what? It only affects the extrinsic value of an option. It cannot touch the intrinsic value. So if you know that as a beginning option trader, rather than going out and buying the cheapest option you can find, which is all extrinsic value, which means you're subject to volatility movement, you're subject to time decay, and if you go far enough out in time, you're subject to interest rate movement. If you buy one that has less extrinsic value in it, then these guys here will affect you less rather than more. Okay, so these are little things that most people don't realize when you get into trading options, and most beginners and even some intermediate people really don't understand that very well. Now, I talked about calls and in the money, and the only other thing I want to show you here is puts. You know, if the stock price is $110 a share with a put, this would be at the money. All right, it'd be at the money also if you were doing calls. But we're just the opposite here. You know, if the stock, let's say, is not 110, but let's call it $100. If it's $100, then a 115 put is what do you guys think that's going to be? Or a 120 put or a 125 put? If I bought a put for a strike price of 125 and the stock is at 100, is that in the money? You bet, man. That's way in the money right there. Okay, and one of the ways to remember this is say, okay, what would the call be? The call would be out of the money. All right, in the money with a call would be some strikes lower than that. With calls, the further you move up in time, the dollar value of that option contract goes down. All right, it goes down. By the same token, when you move up like that, the dollar value goes up in puts. So they're just the opposite. It takes a little bit of time to really kind of just understand that and walk through it, but that's kind of how this works. Now, let's talk about the Greeks. Let's jump into some really cool. I love the Greeks with options because when you start building a position that's just not one call or one put, but you've got multiple legs on there, the Greeks are very helpful. Okay, so what are the Greeks? Well, It's really just a reference point is all it is, and it's based on the option pricing model. And as I pointed out before, options are sensitive to a couple of different things. Options are sensitive to time, expiration, strike price, a whole number of things. Let's put them up right here. This will probably make it a little bit easier for you. Each one of these affects the price of an option contract. Now remember, with stock and you're going long a stock, it's pretty simple. You see a bid and the ask, and you say, okay, well, IBM's worth $100 a share, so it is what it is, $100 a share. But with an option contract, it's more than that. Obviously, as I said earlier, the underlying is the biggest driver outside of the strike price right here. But once you've got the strike price set, the underlying can move that option dramatically. Volatility is probably number two. That can move the options outside of the underlying price movement. So once you've set your option, the game is started, the referee blows their whistle and the game is now playing. Volatility is, how well is the team playing? How's the quarterback doing? Are they passing? Are they catching? Do they seem to be on fire? Or a basketball game? Are they hitting three-pointers? How are they playing? What's the tempo of the game? That's volatility. Timed expiration. Well, we're going to go back into the option chain again, and we're going to lay these all out after we go through the Greeks. But timed expiration is a very simple concept. The further out in time you go, well, guess what happens to the option price? It goes up, both calls and puts. Why is that? Well, if a stock price is at $50 a share, 1 month, 2 months, and 3 months out, well, guess what? That cone starts spreading like that on where that stock price can go. If you're 1 month out, a range may be like that. If you're 2 months out, the range may be like that. If you're 3 months out, the range may be like that. And we'll talk about this range and define it in more precise terms in a minute. But that's essentially how options work. If you go out 2 months, well, it's a wider range. We're going to account for that wider range by charging more for the option contract. If you go out 3 months, it's an even wider range. We're going to account for this wider range in the price of an option contract. All the way down to right here where it's 1 day, it's a tighter range. We're going to account for that with the cost of an option contract. So that's time to expiration. And then, of course, we got dividends and we got interest rates. Interest rates really, most common option traders don't trade in the quantity or the size large enough or the duration long enough for interest rates to matter. Interest rates right now are at 0 to 25 basis points. That's 1/4%. And it's called Rho as far as the Greek term for interest rates. And you usually don't see that too often. But if you go out and you buy a leap, like I just said at the beginning of this session, the CBOE is coming out with their 2015 leaps to expire in January 2015, this December 26th. So you can buy an option contract on the SPX or the S&P and where you think it's going to be in the year 2015. And if you're bullish over the next 2 years, or 3 years rather, you can play that. But interest rates are going to play a huge role in that because interest rates are going to generally go up or go down, more likely go up over those 3 years. So you're going to pay a little bit more for those contracts because they're going to factor in the fact if you're going long, interest rates are going to go up. So they build that into the price of an option. Dividends also affect them as well. Now, one secret about dividends is generally most companies will pre-announce their dividends for the year. There have been some interesting cases this December. In fact, I reported in one of our pre-market sessions the other day, over 150 companies have announced early dividend payouts in December of this month due to the potential tax increases on dividend payments next year. So these unannounced things have a tendency to affect the option price. But generally, most companies are pretty consistent in their dividend payments every quarter. They announce them, so it's already factored into the price of an option when you go out and buy it. So these are the things that affect an option price. Now, if you'll look at this, what's constant? That's constant right there, the strike price. What else is constant? Time to expiration. So when you buy an option, you buy it at a certain strike price. I'm going to buy this at a strike price of 100. And then the other constant is I'm going to buy it and it's got 65 days to expiration. So now that expiration starts ticking down, but it stays there and then it just starts dropping off the table. The underlying price moves every day. The volatility moves every day. Generally, dividends we really don't look at. That's already factored in the price. Interest rates we really don't pay too much attention to unless you're buying over 200 or 300 option contracts at a whip and you're going out more than 9 months. So generally what this means we're going to focus on is volatility, and we're going to focus on expiration or time to expiration, and then the strike price. Obviously, the underlying we're going to focus on because that's what we're trading here. But the things that we really spend our time on are these two right here. This is where we really spend a lot of time. Premium decay or time decay and volatility. That's where we focus our time as an option beginning trader. Now, so basically, the way we measure this, because they vary every day, we measure them with the Greeks. The Greeks is, I'm a former military fighter pilot, so I always use my option instruments. I use my instruments in my dashboard as I'm flying my jet to control what I'm doing. We used to train by putting a hood over our canopy, and we could put that plane in an inverted position. I'd be upside down, but I could have a glass of water on my dash, and it would sit there like I'm right side up. Why? Because I could pull a perfect 1G as I'm pulling the nose down, and yet I'd feel like my sensation would feel like I'm right side up. So you can put anything in a position to do this. I'd use my instruments to determine where I am and what I'm doing at any point in time. Well, options don't have instruments, but in a sense they do. They have something that's called the Greeks, and the Greeks measure this stuff right here. Every minute, every tick, they're measured real time and live. If you've got a trading platform that does not measure these or cannot give you these very easily, don't trade options on that trading platform. Trade them somewhere else. I trade them on Thinkorswim. For our members, we've got special rates that I can get for you, which can save you some pretty good money in commissions. For our members out in our audience tonight, if you haven't contacted me on that, then just reach out to me and I'll talk to you about them. But otherwise, these things run just the way they run. So if we were to come in and we were to look at this, let's talk about the major Greeks. The first one up is Delta. This is probably the one that I think everybody knows about. Even beginners that first get into it, you hear about Delta and you just kind of understand one definition. But there's 4 ways you can define Delta. And I thought I'd spend a little bit of time on Delta and Theta and Vega, which is volatility. Theta is time decay. So let's just talk about these for a little bit. Let's define these 4 ways that you can define Delta. One way is the most common way. It's the rate of change of an option value relative to a change in the underlying. So it's really simple. Delta generally is quoted on a platform like this, but most people read it like this, okay? So it's a 0.50 delta, but they say it's got a 50 delta. So what that means is for $1 move in stock going up or down, the price of that option contract will vary by 50 cents, okay? Now, everything is relative. This thing is real time. So it does not say as the stock goes from 35 to 36, then all of a sudden I'm going to change the delta and I'm going to change the price. No, it goes from 35 to 35.01, 0.02. So it's a gradual change. So this delta gradually changes as that price moves. We'll look at that in 1 minute. But that's probably the most common definition of delta. The second definition of delta is it's not one that you guys really need to play with too much. It's a derivative of the graph of an option value in relation to the stock price. I'll show you that in a minute. Number 3, it's the equivalent underlying shares represented by an option position. It's known as the hedge ratio. Now, as you get into the beginning stages of an option trader and you start going, okay, now I kind of understand calls, I understand puts, I'm actually able to make some money with this stuff. Yahoo, man, I'm rocking and rolling. I can even get I can do a 2-leg position, 3-leg, and all that kind of stuff. But now I got to start understanding, how do I hedge my position? How do I protect my profits? How do I adjust? Well, hedge ratio is very important to understand. And as you start looking at positions, hedge ratio plays a pretty important factor. We'll just touch on a couple of simple examples for now, just to kind of show you what I mean. And then the final definition of options is the estimate of the likelihood of an option expiring in the money. Well, on this Thursday session for our condors, I see a lot of folks here that have signed up for condors tonight. You're going to see where I use the probability of finishing in the money probably more so than I use delta. I mean, you'll hear the term setting your deltas for your wings and condors. I used in the money and deltas, but in the money is a pretty important one to use, and I'll show you what that means. But essentially, all it really says is if I've got a stock, or if I've got a stock that or an option contract that has a delta of 0.50, so we call it a delta of 50, that also means that I've got a 50% chance of that stock finishing in the money. And you remember what we said by finishing in the money. That means that generally the stock is going to finish, and the option is going to have some value to it. Okay, so these are the 4 definitions of delta. The ones that are most important for you are number 1 and number 4 for now as a beginning trader. As you get a little bit more beyond the beginning and you start to get into a beginner plus and then get a little bit more experience and get into intermediate, number 3 is going to become a little bit more important to you, because you're going to use this all the time to hedge your position. Now, so let's go take a look at this. I already said it's the most watched in common Greek. A couple of other little truisms about delta. In the money options have a higher delta. I'll show you that in just one little sample slide I've got here that we can work through that. Out of the money options have a lower delta. At the money options have a medium delta, roughly anywhere from, let's say, 47 to 53. That's what I mean by a medium delta. Lower deltas, generally you're below 45. Higher deltas, you're generally greater than 50. Okay? And if you think about it, it makes sense. If I'm in the money, if a stock is in the money already, then the probability of it finishing in the money at expiration is greater than 50% because it's already in the money. If an option is out of the money right here, then the probability of it finishing in the money is relatively low. It's going to be less than 50%. And how far out of the money it goes, that delta starts going down. You will quickly see that as you start to develop your strategies, delta becomes very important. In fact, when you define strategies and you're looking to say, well, which strike should I cover? Which one should I cover on here? Then which strike should I pick? Then it really is one of those kind of things that says, well, I don't care about the strike. I'm going to pick the strike based on the delta. That's all I'm going to do. I'm going to pick the strike based on delta. So that's why delta is very important here. Now, if we come into definition 1, the rate of change, it defines, as I said, the underlying price move per $1 in the underlying. So if we look at this, you can see right here in this example, the stock moves from $60 to $61, and the call value's at $3 here, the delta's at 50. So when it moves up to 61, that means the call moves up, the option contract moves up in value to 350. But I want you to notice one other really interesting thing right here in this this chart. The other thing that changes is, notice my delta is now 54. Right here it's 50, and then over here it's 54. So what just happened here with this change from here to here is my delta actually increased. and it increased because I've got a call, and as the stock price goes up, that means this call is moving more and more in the money. And the closer it moves to in the money, or the more in the money it goes, my delta goes up. But then as the stock keeps going up, let's say it goes up to 62, and I didn't put it here. Well, then guess what happens to the delta? The delta will probably, let's say, go up to 57. But what happens to the option value? Instead of increasing by 50 cents, it increases by 54 cents. So now this thing is worth, $1.04. So the really cool thing about options is just what you want to have happen. It's the ideal scenario. Your option value is increasing at an accelerating rate. As you get more and more, your bias is right. You're just a rocket scientist when it comes to picking your direction. And this stock is moving up and up and up and up and up and up. And as it's going up, if you just own stock, for every $1 move up, you remember the P&L graph like that? That's stock. For every $1 move up, you make $1. Well, with options, that isn't the case. You get the bias right. For every dollar up that stock moves, you make a greater amount on that option. And it happens not from 61 to 62, but from 61.01 to 61.02, 0.03. So it's happening gradually, but it happens. So you're making money at an accelerating rate. Now, if we take a look at this one right here, let's look at it going the opposite direction. But again, we're with a call. So you move from $3 here down to $2.50. So obviously with a delta of 50, you move down 50. But notice what happens to the delta now. The delta actually decreased. It didn't increase because we went down in price. So now if I go down to 58, if I move down to 58, now that goes down by 46 cents. So my option value now has, yes, it has decreased, but it goes down to $2.04. So rather than decreasing 50 cents, I decreased 46 cents. And then if we were to extend this out again, then this delta would go down again. This delta would probably go down to 42 and so forth. So again, the best of both worlds. If it moves against us, we lose money, but at a decelerating rate. So when you're along a call, okay, the cool thing about this stuff, or along a put, but I'm only showing calls here, you make money at an accelerating rate, you lose money at a decelerating rate. That's their nirvana. That's the best of all worlds in trading these, okay? That is using delta and how the stock moves. Now, if we take a long put, I'm not going to spend a lot of time on it, but the concept works the same. But with a long put, because puts are bearish, the delta is a negative, okay? The delta is negative for a long put. So as the stock goes in our direction, it goes from 60 to 59, right? We're bearish. We're long a put. That's what we want to have happen. The put value goes up. It goes up, and notice the delta goes up. The delta goes from a minus 0.40 to a minus 0.44. So I'm making money at an accelerating rate because I'm bearish. Up here, the delta decreases because why? The stock went up. Remember, I'm bearish, but the stock is going up. It's going against me. So I'm losing money at a decelerating rate. Again, the best of both worlds. This is what happens when you're long calls or long puts. That's the ideal scenario. Now, I don't have it on the screen here, but if we were to change this over and make us short puts, all right, and we were short puts or short calls, the opposite happens. We make money, but it's a relatively slow rate. We lose money at an accelerating rate. And I'll show you that in a P&L graph. So when you are a writer of contracts, you're a credit trader. Remember, your probability of success goes up dramatically when you write an option contract. But because you're going to select the strike that makes the most sense to you, where you've got a high probability of profit. But your return on investment goes down dramatically. All right, so there's no free lunch in the markets. You got to give up something. So, but this is how the deltas of the Greeks move. Now, the second definition of delta is a derivative of an option price. I'm not going to spend a lot of time on this right now, but essentially it just showcased to you, if you were to plot it out and put this in a calculator and measure this with the one of the formulas that derives an option price, you'll see if the stock price moves from here, you've got a curvature of that line, and if it moves here, you've got another curvature of that line, and that curvature measures the increase in delta, and essentially it goes up to where you've got a delta of 1. The highest delta that a stock can or that a option contract can have is 1. And speaking of that, a stock always has a delta of 1. Stock goes up $1, you make $1. Stock goes down $1, you lose $1. So stock always carries a delta of 1. Option contracts, as we just demonstrated, can have a delta from 0.1 all the way up to 1. It can't go higher than 1. It's impossible. Cannot happen. Now, let's look at the third definition. A hedge ratio. This is very important. In absolute terms, as I just said, from 0 to 1 is the delta. 0 when it expires, or it's totally out of the money, it's expiration, it's worthless, or 1. So at option expiration, it's going to be one or the other. All right. Now a call with a delta of 0.60 basically means that the stock price, every time it moves up $1, it moves up 60 cents. So one contract, let's go back to our math as we talked about before, one contract equals 100 shares. We're using this as a hedge ratio because I've got a delta of 60. Remember, if it goes up $1, I make 60 cents. Well, that's like owning 60 shares of stock. So beginning option traders, when you first start trading, you're like, well, gee, what's my equivalent position in shares? Because I'm not used to all this leverage. I bought 5 contracts, and I'm really rocking and rolling here. But you can always do this equivalency thing. If you bought 5 contracts, right, well, then you just come over here and multiply that by 500. It's like owning 500 shares, but you own a 60 delta, which is like 60, so now you own the equivalent of 300 shares. And this is why it's so easy for some rat brain trader to go into Apple and buy 5 call contracts. They would never buy 300 shares of stock, but they'd buy 5 option contracts. And the risk is just like owning 300 shares of stock. So you got to be very careful. But the hedge ratio really shows you what the equivalency is of the stock. That gets very important when you get into the intermediate and advanced stages, where you're going to start hedging and you're going to start using synthetics to really manage your position better. So I just showed you another example here. I changed the delta, so now you got a delta of 0.43. I'm buying 5 contracts. I'm buying them to open, so my total position is 215 deltas. You may have heard the term, what's your deltas in the position? Well, I'm at 500 deltas, or I'm at 400 deltas, or 300 deltas. Well, you got to go back to the underlying and say, well, based on 215 deltas of this specific underlying stock at a 43 delta, you know, I do the math, I run all those out, and then that tells me what I've got in shares of stock, okay? In this case, I own 215 shares if you do the math. 5 times 0.43 times 100. Now, likelihood of expiring in the money. It's very simple. It's not precise, but it's pretty darn close. And I'll show you in the TOS platform when I add a column to my option chain called probability of expiring in the money, you know how close it can get. So an option with a delta of 60 has about a 60% chance of finishing in the money. An option with a delta of 34 has a 34% chance of finishing in the money. So the other thing I want you to know about deltas, they're not constant. As I said before, for every 1 penny rise, they go up, they go down. Also, they're also based on timed expiration and volatility. Okay, so there's a number of things that can affect the delta of an option contract. It's a moving game. Now, What do I mean by call and put pairs? Basically, they're closely correlated, but what that really means is, as a general rule, the absolute value of a call delta plus the absolute value of a put delta add up close to 1. And it gets into option synthetics. For our members, we've got an option synthetics video out there that you can take a look at, but we're going to be doing another session coming up in probably Q1 or Q2 of next year. We're going to go into some real good details on using synthetics and hedging and all that kind of fun stuff. But basically, let me just what I mean by a call put pair is just this right here. If you've got calls over here and then you've got puts over here, so a pair would be you got 100 strike and 105 strike and then 110 strike. A pair would be something like this. The price of this, let's say, is I don't know, $3.50, and the price of this is, let's say, $3.15, something like that. Well, the delta over here may be 0.55, and the delta over here may be 0.45. So what that's saying is if you add up the delta of a call and a put pair at the same strike, you're going to get roughly, and this would be a minus, the absolute value of it would be roughly around 1. Now, for all you quants out there, yes, it can vary. It can go up to 1.02, 1.03, or 95, and that's based on interest rates and some other fluctuations. And sometimes if you get really deep in the money, it can also vary a little bit. But it's a pretty good mechanism here just to kind of give you an idea of this. And the reason why it works this way is because if markets get too over or underpriced, if puts get too expensive in relation to the call side, or calls get too expensive in relation to the put side on any one strike, you're going to have arbitrators come in there and buy one and sell the other right away, or buy the stock and sell the other and short it, and they're going to come out and they're going to make a profit, and they're going to force the prices back in line. You guys can't think that fast, or you can't move that fast. They have black boxes that do that all the time, so you don't need to worry about it. But there is a symbiotic relationship between puts and calls at the same strike. Options, as we said, in the money have a higher delta. Options at the money have approximately a 50 delta. Options out of the money have a delta less than 50. So these are the effects. And then the time decay effect on an option or on delta, basically, the more time you have left until option expires, the less certain is whether the option is going to be in the money or out of the money, right? If you've got an option that's got 1 day to expire, then you've got a pretty good probability of whether that thing's going to finish in the money or out of the money, unless it's sitting right at the existing price. If it's out of the money or in the money, you've got a higher probability of where it's going to be. So therefore, the deltas of both in the money and out of the money options reflect that uncertainty. Therefore, in the money option deltas increase as expiration approaches. So even though the stock may barely move, but as you get into the last week of expiration, that delta may go from 60 to 75 to 80 to 90, even though the stock really isn't moving up that much, because expiration is coming due, and that basically says the probability of that finishing in the money is greater and greater and greater. By the same token, out of the money option deltas decrease as expiration approaches, because then the probability of that moving into the money goes down. Okay? So just understand that. As you get into more of an intermediate style trader, you're going to be looking for that, especially if you're trading monthlies and you like to trade the last 2 weeks of the month, or you're trading weeklies. What's the effect of volatility on delta? Well, if you think about it, volatility increases an out of the money's delta. And in the monies, it decreases. Why? Because volatility means the stock is moving larger amounts. So if you just sit back and think about the logic of it, if you've got higher volatility, a stock is going to move like this, right? It's going to move like this. Higher volatility. It's moving around. So the stock is moving. If you've got lower volatility, the stock may do something like this, or it may just be kind of a steady eddy moving like that. So when volatility is really high like you've got here, well then the probability, the delta is going to increase, hence the probability of finishing out of the money is going to increase because now this thing can move more and it can move out of the money. So therefore it's going to decrease. In the money deltas decrease. Or out of the money increases rather. So the higher the volatility, deltas go up. In the monies, because now if you've got volatility increases in your you're in the money, then the delta is going to go down just a little bit because now it's got an opportunity of finishing out of the money. So if you think about it, it's really quite logical. And by the same token, it moves just the opposite if volatility decreases. So that is delta. It's a lot to chew on as a beginning trader. Remember, you can come in and watch this video again and again. You're going to have to play with this. And remember, as a beginning, I'm giving you a little bit more than just basics here for delta. But the main thing I want you to focus on is delta is for every $1 move, that delta tells you what the change in the option price is going to be. Now, gamma, most beginning traders really don't focus on gamma. And it's basically the rate of acceleration of the speed of delta. It's the rate of change of delta given a change in the price of an underlying. And it's generally stated in terms of deltas per dollar move. And it's the second derivative of the graph. So just like delta, gamma is not constant. And in the money and out of the money options have lower delta. At the money has a higher gamma. And at the money has a higher gamma. So if we were to talk about this, gamma basically tells you for this move here from 60 cents or $60 to $61, we know delta is going to go up, but how fast will delta go up? Gamma tells you that delta is going to move 4 points. Okay, so gamma is essentially telling you how fast will delta move up and how fast will delta move down. So it is the second derivative of the first derivative, which is delta of the underlying. So I don't want to complicate you too much, but as you start getting into a little bit more intermediate topics and more sophisticated option strategies and trades, you will be watching gamma. And in fact, advanced traders, we've got a session, I think, out there on gamma scalping where you can scalp gamma instead of staying delta neutral. You really want to play gamma. But that's for a topic for another day. So that's all I really want to focus on gamma right now. But again, same thing with long puts. As I pointed out, notice with gamma though, one thing I do want to point out, gamma is positive. Gamma with puts and calls is positive. However, delta is, as I said before, for puts, it's negative, okay? Now, when you buy long options, you require positive gamma, all right? So long options have positive gamma, and it gives you that what I call that smile that you get in your P&L graph. So if you've got a, let's say a long call like that, you've got a P&L graph that looks something like this. You guys know what I'm talking about that are trading all the time, but basically I'll show you on an option view chart, but this line moves towards the solid line as time expires, but it gives you that positive gamma smile. And it helps you because it causes options to gain value at a faster rate and lose value at a slower rate. We talked about that with delta. However, when you short options, meaning you remember you're going to sell to open, so you're the option writer in this case, you acquire negative gamma. Negative gamma is very appropriate. You get what's called a frown on the P&L graph. For the P&L looks like a frown, and I'll show you that in just 1 minute. Negative gamma works against you. Your losses accelerate. So credit traders have to be very good at managing their losses, otherwise they can wind up in trouble. Theta is, I think, where a lot of people spend a lot of time. Basically, we talked about option values are broken out into two parts, intrinsic and extrinsic. Intrinsic is very easy to measure. It's basically the in the money portion of the option price. Extrinsic is considered time premium. Remember, we talked about that term, time premium. Everything that's extrinsic is considered time premium. Now, the decay in an option value, it decays because time premium passage is measured by a Greek called theta. Theta measures time decay. So we want to know what theta is all the time. Why? Because you may have an option strategy that gives you a theta and you're looking to manage your theta. And as you get into some more advanced topics or you're starting to roll options from month to month, you may say, well, when do I roll my option from the front month to the next month as I'm rolling my positions? You may use theta to determine where you're going to capture the most decay and where does it make sense to roll. Now, the other thing I wanted to point out with theta is if you're long options, you have negative theta. What does that mean? Well, if you buy a call every day, that call is going to waste away a little bit of price value. So it's got negative theta. It's negative to your position. However, if you short options, it's positive theta. When you sell an option contract, you're a writer. What do you want to have happen? You collect that premium up front. You want that thing to decay right away. That's what you want. So you do not want the thing to not decay. So positive theta if you're short option, or theta if you're short options. By the way, if interest rates are above zero, then call theta is going to be higher than put theta. However, because we've been in such a low interest rate environment for the past couple of years, you're really not even going to notice the difference, quite frankly. You're just not going to notice with 25 basis points out there. But as a general rule, you're going to get better theta on calls than puts. Now, volatility will affect that as well. At the money options have the highest theta. Why is that? Well, that's because that is the highest value of an option contract before it starts going in the money. All right, that's at the money right there. And therefore, that's the highest value. That's where it can decay the most. Only options extrinsic value is subject to theta. Remember I told you that before. If you've got an option value, and let me just see what this says. Same thing with volatility. Higher volatility, let me just go back here. Higher volatility also increases an options premiums. Thus, if they increase the premiums or the time premium, you got more that you can decay. If you've got an option that you paid $8.50 for, $5 is in the money, as I said before, so this is intrinsic value. $3.50 is extrinsic value right here. And you've got 3 months for this option contract before it decays. You know, in 3 months, all that $3.50 is going to become worthless. So what you want to have happen is that stock to go up in value more than that $3.50 because it cost you $8.50. You've got to have it go up and counteract that decay right there. Otherwise, you're going to break even or you're going to lose money. Okay? If you're going to hold it to expiration. Most people do not hold their option contracts to expiration. This is where a lot of beginners get into trouble because they look at the P&L graph and they look at it, and most P&L graphs are just that. They are solid lines like that. What they're not seeing, however, is the actual P&L graph when they put on the trade. You know, it may look something like it may, I don't know how that happened. It may look like something like that. That's the actual P&L graph like that. And then the very next day it goes down like that, and the next day it goes down like that. So the P&L graph is a curved line until the day of expiration. It assumes that straight line like that. Now, there are certain tools that will allow you to play with it. I'll show you how you can use TOS to do that. You can also, I love Option View. I use that as a big time view to talk about my trades with options, but I'll show you here tonight with TOS. So this is theta. Now, one other thing about theta is it's not linear. The higher the extrinsic value, the higher theta. So here's one thing I want to point out to you guys that really is important. If I were to draw a dashed line, straight, hopefully. This is the dollar value of that option contract right here. If you look over a 30-day period, right here, Theta only decayed that much. Didn't decay very much. But then look at the next 30 days. It can go from here all the way down to here. So the bulk of the Theta decay happens in the last 30 days of the option expiration period. In fact, if you break it down into the last 30 days, you will see that the last 15 days comprises, well, let me just do it a little bit better. Let me do it another way. The last 15 days here comprise almost 50%. I'll come up to the line. Almost 50% of that value. So if you look at this and you say, well, gee, how does this thing decay over the last part here? And we come up to 30 days right here like that. You can see it's even more than that. So Theta decay decays at an accelerating rate, and most of the decay really happens in the last 7 to 8 days. Okay, that's where most of the decay happens. But most credit trade players will generally, when they're shorting options, strategies dictate that you stay within 30 days unless you've got other strategies in place. So understanding how these prices are derived and how these things decay are very helpful for you in picking your strategies. Now, Vega. Vega is really important here. It measures the rate of change of an option's theoretical value relative to a change in implied volatility. I'm not going to spend any time tonight going through volatility. That is a whole intermediate session in and of itself on statistical volatility, implied volatility, and how these things are calculated and how you use them to trade. And there are a lot of strategies that trade off of Vega. All I'm going to do tonight is just show you some of the basics around Vega as it relates to basic calls and puts. Basically, implied volatility, there's really two to keep it really simple. Let's say this is August of 2012, and this is today, and then this is March of 2013. Okay, now so obviously this is what's the stock done. This is how the stock is moved. This is where it is right here. What we don't know basically is, where is this stock going to go here? Where is it going to end up over here on this date right here? Well, this measurement right here is called historical volatility. It's very easy to calculate. We calculate historical volatility, and it'll tell us what the volatility of this stock has been. If we look at this, there is also an implied volatility with this stock. We can go back in time and see that implied volatility was something like this. It may have looked like this. You know, that could have been implied volatility right there. So, you know, we've got something that looks like this for IV. Implied volatility is that color right there. And then historical volatility basically is, you know, this color right here. This is historical volatility right here. But we do know for a fact what historical volatility is, and we do know for a fact whether implied volatility was higher or lower than historical volatility. We know that for a fact. What we don't know is what's going to happen out here. So what the option market does is it says, well, let's look at historical volatility, let's look at implied volatility, and let's imply or let's guesstimate where we think IV is going to be over here. And they imply a volatility. They imply a price movement. So in the option pricing model, you know, they plug in the underlying price of the stock. They plug in the dividends. They plug in the interest rate. They plug in the strike price, right? They plug in the time of expiration. The only thing that is the last thing that goes in is implied volatility. Implied volatility is put in to come up with the price of that option contract. So that's how implied volatility comes to being. And then if we look at this and we say, okay, implied volatility, and I'm just going to come down here to a couple of key points here that I think are very important. Implied volatility here with this price here, when IV rises or falls, option prices rise or fall in line with that volatility. Because if a stock is moving a lot, well, the option price is going to go up. If a stock is moving like that, then the option price is going to go down. It's very simple. Long options have positive Vega. That's very important. So when you buy a long call, if volatility goes up, the price of that option contract is probably going to go up. You're going to make money even if the stock doesn't move or it moves a little bit. However, if you're short options, you've got negative Vega. And negative Vega can be good or bad depending on what your strategy is and what you're trying to do. The higher the time premium, the higher the Vega. Remember what I said about time premium. Time premium is that part that is what? It's the extrinsic value of an option price. The deeper in the money you go, the less extrinsic value. So you can control your Vega just by going with a higher delta or more in the money for a stock option price. At the money options have the highest Vega. Why? Because that's where the extrinsic value is the highest. So naturally, if Vega or volatility only affects extrinsic value, the higher the extrinsic value is, the more Vega is going to affect it. And the highest extrinsic value is generally found at the money options. So Vega is most sensitive to at the money. All right? So it's logical if you just think about it. Now let's look at something here. Let's look at this example here just to show you how much volatility can affect us. Let's say you got an option valued at $1.68 or 168 bucks, all right? And Vega is quoted as 0.06. What does that basically mean? Well, that basically means that for every 1 percentage point increase or decrease in volatility, your option price is going to change by 6 cents. So let's say volatility increases from 22 to 25%. And believe me, folks, it can happen by the time you blink your eye. A news thing hits the wire, anything happens, and the stock doesn't move at all, but volatility just goes up. If it goes up from 22 to 25 and we're long a call, well, the option value is going to increase by 18 cents because you take that, it increased by 3 percentage points, so 3 times 0.06 is 18 cents. So it's now worth $186, or roughly 10.7% increase. You just made a profit of 10.7% by just sitting there just because volatility went up by 3 percentage points. All right? Just it's pretty dramatic how this can happen. Let's look at another one that's even more dramatic. Here's one that moves against you. If you look at this one, volatility, in this particular one here, volatility decreases from 45 to 28%. We see that happen a lot around earnings, right? Earnings are up very high because the market makers don't know which way that stock's going to go. They don't know how the earnings are going to do it. So what do? They increase the price of the option. How do they increase the price of the option? Well, IV is the last component inserted into the option pricing model, so they jack up volatility. As soon as earnings are announced, everybody knows what it is. Volatility is what? It falls off the table. So you'll see something like this. It's quite common. Now let's look at the stock. Let's say the same stock at $1.68, it's worth that right there. We're long it, so we're long Vega. But Vega decreases by a pretty good bit. Vega goes from 45 to 28. So it decreases from 1.02 to 0.66. The value decreases by that amount because it decreases 6 cents for every 1% move. And because this thing moved more than 1%, it moved a pretty good bit, then what we've got here is I had a 60.7% decrease in the value of this thing. So it went from $168 down to $66 just on that vol crush. You may have heard the term volatility crush. That's what's happened. And I've coached a lot of people that are beginners that'll go in and buy a long call and they'll pay $3 for it, and they think the stock is going to go through the roof at earnings expiration. Earnings comes out poor. The stock really doesn't move very much, and you have a vol crush. Or better yet, let's look at it more realistically. They think earnings are going to come out good and the stock's going to go from $40 to $60. Well, it doesn't go that much. It goes from 40 to, let's say, 45. You're like, well, I bought a call. I'm going to make some money. Well, guess what? Even though the stock went in your direction, volatility came down more than the price of the option increased by the security. So you had a vol crush. You paid $3 for it, but now it's worth $2.10. So you got overcome by a volatility crush. That happens all the times to beginning traders. So you've got to be aware of that. And basically, volatility in an option is based on what's called a random walk. If you take this ball here and you drop it down, it comes right there. It's got a 50% chance of going this way or a 50% chance of going this way. And then when it hits this one, it's got a 50% chance of going this way or a 50% chance of going this way. So this random walk theory says every tick change, it's a 50-50 whether it's going to go up or go down. So all of option pricing is based on this random walk theory. And there'll be arguments as long as the day is here until the end of days on whether that's valid or not. But this is how option pricing is created. So when you drop the ball in and you go all the way down, you have one of these kind of distribution curves like this. Generally, it kind of, generally what will happen is based on the 50-50 kind of play, it'll go boink, 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 right like that. 50% over here, 50% over here. But every now and then you're going to have the outlier that continues to defy odds. It's kind of like tossing coins, and it keeps going tails. You can toss a coin, and I'm not going to go into the probability and stats on it, but this is the way options pricing is determined. And based on this standard deviation, you'll see that 68% of the time, that's one standard dev. All right, that's just one standard deviation on a price movement of a particular stock. 95% spreads it out even more, like this. So 95% of the time, over a given period of time, stock will stay in this range. 60% of the time, it'll stay in this range right here. So graphically, if we look at this and we look at the calculations, it'll look something like this. Now, when you see an option and you see a stock, and you see a stock that's got a volatility of 45%, what does that really mean? What that means is that stock can move the price of that stock 45%. It's annualized over an annual period. But how many of you say, well, shoot, I'm going to trade this stock. It's at $100 a share, and volatility of 45% is pretty high, but that means the stock can finish at $55 a share or at $145 a share at the end of 1 year. That's the range at that volatility right there. Options are going to be very expensive here. But how many of you trade an option 1 year out and you're going to hold it for 1 year? You don't do that. You may trade it 1 week out, 1 month out, 2 months out, but everything is quoted on an annualized basis. So you need a way of converting it. Now, you don't have to worry because your trading platform will do that for you. But you can use this calculation right here, and it'll calculate for you a move in 1 day based on volatility. I'm not going to go through the math and waste our time this evening doing this, but this just shows you everything is calculated, and volatility really is the great white shark in option pricing. Now, Rho, I'm not going to spend hardly any time on this. It's interest rates. If interest rates go up, call values go up. If interest rates go down, call value decreases. Okay? It's usually the least followed Greek. So, for example, a call with a Rho of 0.12 and that's very high. That means that that option value will increase 12 cents or $12 if interest rates rise by a full 100 basis points, full 1%. And that's not on a quarterly basis, that's on an annual basis. So you divide that by 4 and you get 3, so it's just not worth the effort with Rho, especially most of these have a .001 or .01 or something like that, because you're usually trading 3 to 6 months out. So that's pretty much how that one works there. So the other one is, let's come in here, take a look at dividends. We talked about this for a minute. Paid dividends decrease call value and increase put value. There are 4 key dates that will affect an option if you're holding an option contract that they're declaring dividends. The declaration date, that's kind of when a company formally declares a dividend. The ex-dividend, and I'm surprised. Usually when I coach a lot of people don't realize this. They don't know the dates. So they got a general idea, but they don't know how they work. Ex-dividend date is always 2 days before the record date. And the record date is due to stock settlement. It takes the exchanges give you 2 days to settle the stock. The record date is the date of record for who gets the dividend payment. And then the payable date is the date of payment. So basically how that's stated is ABC Corp, right here, we'll just walk through the example. ABC Corp announces on March 31st. They announced it, so the March 31st announcement is the declaration date right here when they formally declare the dividend. It will pay a 25-cent dividend to shareholders of record on April 3rd. That's the record date. That's how they announce it. So we'll pay it to shareholders of record on April 3rd, payable April 23rd. That's the payable date right here. The market participants wishing to get the dividend must own the stock on April 1st. Even though the shareholders of record is April 3rd, all right, the ex-dividend date is April the 1st. And the ex-dividend date is 2 days before the record date. All right, so you just have to kind of go through this and think through this, but this is how it works. And it generally by the way, most quarterly dividends have been announced well in advance, for a year in advance, so they're already reflected in the call price. It's just those unannounced dividends, like 150 companies did this December, that will cause the call value to immediately decrease and the put value to immediately increase. Okay. Now, one other key point. If you're a holder or a writer of an option, you do not receive nor do you pay dividends. Okay. Now, here's the summary. This is a really nice summary for you guys of the Greek effects on the underlying. And just a couple of key points here. And I put this chart together because I thought it'd make it a little bit easy, because it can be a little bit difficult when you first get into it trying to figure all this stuff out. Long stock and short stock, I want you to notice that there is absolutely 0 Vega, Theta, and Gamma. It's very simple. And your delta here is very simple. You've got 1. It's just 1 is your delta, of course, or -1. It's either 1 or -1. If you're short stock, for every dollar it goes down, you make $1 and so forth. It's very simple. Now, where it gets interesting here is I want you to take a look at a couple of things. If you're long a call or you're long a put, there are some similarities here. Your positive gamma for long calls and long puts, your negative theta, and your positive vega. So all you got to do with long calls and long puts is just know that with puts, your negative delta, your positive delta with long calls, but everything else is the same. Your positive gamma, your negative theta, and your positive vega. By the same token, it's just the same way when we go into the short side of the house. If you're short a call or you're short a put, well, again, it's going to be just the opposite. If you're short a call, your negative delta and your positive delta down here. But everything else is going to be the same. You're going to be negative delta negative gamma and negative gamma here. You're going to be positive theta. You want it to help you out there, and you're going to be positive theta here, and you're going to be negative vega here and negative vega here. So all you got to do is remember one of these, and you got the other two licked. It's pretty simple. And this is very, very important, because once you start trading multi-leg or even single leg and you want to start doing adjustments, you got to know this stuff. You got to know your position. And then it makes trading options, as I said at the very beginning, all about math. And one other thing that I put together here for you, which will really, kind of make it easy for you as well. I basically said, well, gee, if your Greek position here is delta position is positive, let me choose a different color so you can at least see what I'm doing here. If your delta position is positive, well, then what do you want the stock to do? You want it to do this. If your delta position is negative, what do you want it to do here? So I'm not going to go through all these, but this tells you if you've got this, what do you want the stock to do? Now, it gets a little bit more complicated when you got both 2 or 3 or 4 leg positions. And what we talk about in some of our education sessions and when we start getting into the deltas is managing your position and you're managing your deltas, and it does make hedging a lot easier for you. So that's kind of where we're sitting here. So that's pretty much what we're going to be covering here with options. And if I come in here, one other thing I wanted to leave you with here, this will also be in the recording. It's very important. It's just a trade selection strategy checklist here. And what this checklist does is, as a pilot, I like to have everything checklist. After a while, you get to where you look at it. But I don't care how you do your security selection, and you may have a scanner, you may have a watch list, but once you've got that, you've got to develop, once you've got your security, you've got to develop your bias right here. That's what you've got to do. Neutral, mildly bullish, mildly bearish, strongly bearish, or unknown. And then volatility trades. Once you've picked, let's say I'm strongly bullish, that's my play, then you come in and you define the magnitude of the forecasted move and the time frame of the forecasted move. Remember, we're in options now. So when you come over and you look at an option price and an option chain, you've got both magnitude and forecasted move and time frame. What trigger price am I going to use to say I'm going long or I'm going short? Where's my support and resistance points? Because remember, you got to select strikes. You got to know what you're going to be doing with that. How do I know if my original bias is wrong during the trade? In other words, most people don't think about that, but once you get into a trade, you got to have you do all this before you get into the trade. What's your current implied and historical volatility? You should have all this worked out here. What's your risk appetite? Meaning, I know what my primary exit point is in this trade before I get into it. I know what my secondary exit point is before I get into this trade, and I know where my stop outs are right here. My secondary exit point may be I'm in a credit spread and I'm just going to take a loss and get out. Or it may be if it hits this point here, I'm going to do an adjustment, or I'm going to hedge with stock, or I'm going to hedge with some opposite. I'm going to reduce or increase my delta or vega or whatever. I mean, then my trade objectives. Is it just an income trade? Or am I looking for downside protection? I own stock and I just want to protect the downside. Or I'm in an existing option trade and I want to protect my profits. Or am I going for a max revenue gain of over 20% or more? So all of these factor into this play here. Now, if we come over, and let me just, we're going to end this up. I'm going to go into a trade window here. Let's go in and let's just pick up, we'll pick up the diamonds again. Or let's go with the spiders this time. And then we'll wrap it up on this. If we look at the spiders, let's come out here to January. You'll see right here, I left it the way I left it last evening. You'll see in here that I've got open interest, bid and ask, and then I've got open interest volume and bid and ask right here too. But now that we know the options, what we want to do is let's just come in here and let's add in here delta, gamma, theta, vega, and then the bid ask. One thing I'm going to add in here is I'm just going to add one of mine in here. one of the ones that I just added in here is probability of in the money. Notice I've got my columns all saved up here. I've got different columns. I've got weeklies. So if I'm trading weeklies, I've got a different weekly layout than if I'm trading monthlies. By the way, I haven't announced it. We're going to be coming out with a weekly educational series too, or how to trade weeklies. There's some keys to that you got to understand. That's going to be next year too. We got a ton of stuff coming out next year. But anyway, with this one right here, if you take a look at this, one thing I want to point out to you, if you look at probability of in the money right here, and then look at delta right here, you'll see they're fairly close to each other. Remember we said delta is a probability of finishing in the money? Well, right here, this is a 54. You may not be able to see it. That's 54. This is 52 right here. So they're fairly close. It's an approximation. So when I'm setting up trades, I may, if I'm going further out in the money, I may also use my probability of in the money, because this is going to tell me, this is all calculated, and the cool thing about this is this did not exist 10 years ago, but this tells you on a tick-by-tick basis, based on volatility, what's happening. So it really runs it down very well for you. Now, if I come in here and I also, let's just show Vega, volatility, you see how volatility is quoted right here. Okay, so volatility, as I said, is quoted as a point. So that's 0.19. So volatility there is 0.19. So that means for every 1 percentage point move in volatility, my option value is going to go up or down by 19 cents, depending on whether I'm long or short. If we look at Theta, Theta is quoted the same way. Theta is 0.03. That means I'm going to lose 3 cents a day on that Theta, okay? And obviously, the further out in time we go, Theta gets lower and lower. Remember I said Theta declines at an accelerating rate. If we look at the weeklies, and we look at that same option near the money, if you look at Theta here, Theta is 3 times greater. Theta on this one is at 9 cents roughly. So that's 9 cents a day. And this is out of the money. It doesn't have much, and this Theta is going to go up even more tomorrow. When this thing opens tomorrow, Theta is probably going to be, you know, in the teens or 20s. It's just going to be just wasting away because it's out of the money. All right. Theta is one of those kind of things that expires at an accelerating rate. So as you start getting into these, and as you start putting trades on, then you really want to take a look at how this works. Now with TOS, I could come in here and I can say, okay, let me just put something on with a spider here, and I'll just throw something on here. Here's the sample iron condor with the spiders, and as you can see right here with this sample iron condor, you can see right here with my live position right here, I've got that as live, and this is not a trade. I'm just modeling this one, so don't take this as a trade recommendation. But you can see here, I've got my gamma defined right here as minus 11.55. I have my delta defined as minus 0.33. I've got my theta defined as positive 5.76. Vega defined as negative 33.52. So now those are that's my instrument panel. As this stock moves up and down, I can use these to say, do I need to hedge? Is my delta too high or too low? What about my gamma? How about my theta? How about Vega? What happens if volatility falls through the roof with a negative Vega? Is that good or bad? What happens if volatility goes up? If I've got a Vega there that's like 600 positive, and I'm afraid something's going to happen to me where volatility is going to fall through the roof, I may get crushed. So I may say, I may want to adjust this by reducing my Vega. And then there's strategies on how you adjust your Vega and keeping your position. So as you start getting more, and options are really cool. It's all about math, as I said. As you start playing these, you can start learning how these things work and how to manage these. As I said earlier, we've got individual sessions on this, and they're running sessions. We may be running some of these at the same time. You feel free to come out to our blog. I got posted out here, traderusergroup.com. Go out there, go take a look at our blog, look at some of the sessions that we've got running. For those of you that are a number of people, once you attend them, you'll attend. They're very inexpensive, guys. So check them out. It's a good way to get into this, a good way to learn how to trade. All right, everybody, I'm about talked out for this evening. I extended a little bit longer, but I just wanted to spend a little bit of time on the Greeks and just review some of the basics for you. You guys have a really great evening. I hope you enjoyed the session. And I will, if you have any questions or any particular questions you want to ask me, you got my Skype out there. Just send me a Skype message. Yep. Thanks, guys. Thanks. Have a really good one. Bye. Cheers. See you guys. Good night.